Hello and welcome into the KE Report. I'm your host, Shad Markwitz, and we're getting an update today from Robert Sinn, also known as Goldfinger on CEO.ca and CeoTechnican on X. He's the publisher of Goldfinger Capital on both YouTube and Substack, and we will put links below this interview so you can follow along with Robert's work. Man, Robert, we got to talk about the Fed and gold. It's been a wild couple of days here. A lot of anticipations about the rate cutting cycle finally starting. I feel like we've been waiting for this for 2 years, and we finally get the 50 basis point hike. So you were spot on with calling for the 50 basis points. Now, the gold market had a big spike, then a drop at the end of yesterday, then it's back today. What do you make of the turbulence?
Thanks for having me on, Shad. Yeah, I think the turbulence is to be expected after the move we've seen. 2,600 is a lofty level. We haven't been here before. This is literally, to use an overused expression, we are in uncharted waters, but it's true. So, of course, you're going to have some selling on the news. You're going to have some consolidation around this level. And actually, I'm a paranoid gold trader. So I always keep thinking about reasons why I should sell, reasons why I should call the top here. And I just can't come up with them. I try so hard sometimes, and I'm just like, no, just stick with the bull here. This market is acting great. We're not crazy overbought yet. Sentiment is not extreme yet. And the fact that even after a 50 basis point rate cut, which was a surprise to a lot of people, not a surprise to some, including some who may have been tipped off by Powell last week, like the guy at the Wall Street Journal, but definitely a surprise to a lot of people. And certainly 2 weeks ago, nobody was thinking about a 50 basis point rate cut. 2 months ago, it was completely off the table. And then it happened and gold didn't go up, right? So not extreme, still plenty of sellers, still plenty of skeptics out there. So yeah, I think this volatility is great. And if some people got shaken out at the end of the day yesterday, well, then they missed out on some more upside here this morning. And I think for gold investors, I mean, this is, what I'm doing myself, just focus on the bigger picture, focus on the bigger picture trends. Don't get caught up in the day-to-day noise. The Fed has just started an easing cycle. There's a lot more rate cuts to come. And that is a tailwind for precious metals.
Well, just to that point, you had been making the case to your subscribers that if you did see any pullback on the volatility after the Fed's first cut, that you kind of wanted to buy that dip because, to your point, the larger trend, I mean, really, since that triple bottom we saw back in late 2022 at the 1620 to 1618 range, gold's been on a rocket ship ride where it's up $1,000 from there over the last 2 years, and the trend has been staying above the moving averages. It's been a solid progress where you're seeing new daily highs, new weekly highs almost every month. I think 6 or 7 months in a row now of solid candles. When you look at that technically, do you think that there's the momentum just to keep the trend going? Do you have any upside targets? How are you looking at it technically?
Yeah, I mean, I think there's a few different ways you can look at gold here technically. One is to compute a breakout target from the cup and handle, the bigger picture cup and handle. And some guys do it different ways. The way I do it, the really old school way I learned when I first read a technical analysis book 22 years ago, my target is 27.27. So to sharpen my pencil, get out my calculator, do the math, it's 27.27. And I've been consistent with that target for over a year now. Whenever I'm on a podcast or I'm talking to people or doing a blog post, I use a 2,700 round number. I don't use the 27.27, but to be exact, it's 27.27. That's one way to do it. The other way to do it is be like, well, often these cup and handle breakouts go for 50%. The breakout was around 2,000. So 3,000 is our target. And again, to be exact, it would be more like 3,100, but let's just call it 3,000 because the breakout was actually at 2,100, not 2,000. So that's another way you can do it. And then even yet another way is you can inflation adjust highs, like the 2011 high, the 1980 high, and you get different numbers, depending upon which one you use, but the targets are a lot higher. So in my mind, the targets just give you maybe a guidepost to when we get really overextended, like, oh, shoot, we actually achieved the target. Let's take half off the table. But by no means is a target like an exact number that's going to be a top. Like there's no way technical analysis works that well, right? The most important thing is to just follow the trend until the trend is broken. If there's one word of advice I could give to somebody who's learning charting, it's follow trends and try to follow them as long as you can, and don't get moved in the near term by noise. A $50 move in gold is nothing. It's nothing in the grand scheme of things. Like, we'd have to see gold break back under 2,400 for the longer term trends to be called into question at all.
Well, I think those are some solid advice. Like they say, the trend is your friend until it isn't, meaning you ride that trend until something significant changes. Now, when people look at the breakout in gold and then they pivot over to their portfolio of gold stocks, they kind of have a bifurcated feeling. Like, hey, look at gold continue to make all-time highs, but then look at the gold stocks. They are participating. The majors, some of them have responded. Some of the mid-tiers have responded. It hasn't really filtered down into a mania or euphoria. But if gold only goes up another $100 to maybe $300 to $400, are these gold stocks going to finally start to play catch up? What were your takeaways from the environment we just were in Beaver Creek last week, where we were meeting with a lot of these gold companies?
Yeah, it was really surreal to be like checking quotes on the way to a meeting and see gold ticking up 25.60, 25.65, 25.70, 25.80. And then like a meeting with a junior that's got a 12-cent share price or a 16-cent share price. And, they're maybe thinking about raising a couple $1,000,000. And so gold is just soaring, making new highs almost every minute, every hour. And some of these companies are still pretty hard up. It's not like the gold move has translated into a lot of juniors. Now, on the flip side, there were some bigger companies there, some mid tiers with market caps above 500 million that have had really nice share price moves in 2024. So, you can't make a blanket statement, but the bigger companies are benefiting. The smaller ones have not really, seen the fruits of a higher gold price yet. But I feel like this is how this sector goes. And I think sometimes we forget this and we think that, oh, gold is up today, so my juniors have to be up. But no, if we think back the last 20 years or so, the juniors, like in the 2002 to 2007 cycle, the juniors really started going in like 2004, like fall 2004, and they really ripped in 2006. So that was like a 5-year cycle for the juniors. And the biggest gains were in the last 12 months of that bull market, right? And then 2009, they bottomed at the bottom of the global financial crisis at like literally pennies after dropping 90%. And end of 2010 and early 2011 was where the biggest gains, were had. And then there was a top in like March 2011 or something. So again, patience is a virtue. Sometimes it's very hard in the junior mining sector, but often the biggest moves happen in the final stretches of a precious metals bull market, right? So maybe this time is just no different. We've seen the seniors move. The mid tiers are moving as we speak. Great last couple of weeks in a lot of those stocks. And the juniors will be next. Now, could that be next week, next month? Could it be early 2025? None of us have a crystal ball. But my guess is with the Fed cutting rates, it's coming, and it's probably coming sooner than later.
Well, when you look at previous cycles, to your point, you always see the big ones move first, then the mid tiers, and then it moves down to the developers and eventually explorers. We see that every time, yet people seem to have amnesia that this is exactly what we see every single cycle. But at this point, we also have heard for a couple of years now about margin contraction, rising costs. The reason the miners are dislocated from where they are and why the GDX and GDXJ aren't higher is because of rising costs. Well, right now, the average cost for a miner is about $1,500 to $1,600 an ounce. We're at $2,600 gold. That's $1,000 margin. Those are the biggest margins we've ever seen, bigger than 2020, bigger than 2011. Do you think analysts and generalist investors start going, holy crap, these gold companies are actually making money?
Yeah, I think the $1,000 margin which is what you just stated. Like, we are literally at $1,000 margins, even for the higher cost miners that have a $1,600 cost per ounce. So yeah, $1,000 per ounce is a pretty nice margin. And companies like Newmont or Barrick, well, they might have a $1,200 an ounce margin here because they're more like $1,400 on the all-in cost basis, right? Those are pretty hefty margins. So as long as they can deliver, keyword, cost containment, as long as costs are moderating and stabilizing here in 2024, which by all accounts, looking at the CPI inflation and the price of oil dropping in the last couple of months, they should have their costs in line. Knock on wood, fingers crossed. We've been burned many times in the past, but maybe it's the trend is changing. Yeah, the Wall Street analysts are going to be redoing their models, and the free cash flow is going to be enormous for a lot of these companies like Newmont, like Barrick, like Kinross, and that is the mother's milk of share price gains and getting some new shareholders into the sector. So God willing, Shad, it's happening.
Well, do you think that leads to more M&A? Because as their paper becomes more valuable, can they use that to play the arbitrage between the juniors?
Yes. And that's an important point you make, the share price, their currency. And this is something a lot of investors don't understand. A lot of investors just look at one side of the equation and they say, well, my junior has 5 million ounces and it's 100 million market cap. That's $20 an ounce of gold in the ground. Why isn't somebody paying $50 an ounce and taking this off my hands so I can go into something else? And the answer is, well, they just don't. The acquirer is not ready yet, and they don't sense any urgency because your junior with 5 million ounces that's being valued at a paltry $20 an ounce isn't doing anything to raise their valuation. The market just doesn't find it interesting right now, and there's a bunch of companies in similar situations. So until the acquirer has a need and they feel they can do a deal on good terms for themselves and their shareholders, they're going to wait. And that's what we've seen for the last many years, is a lot of these companies with feasibility studies that are at the permitting stage but may not actually have the permits yet, but maybe in the process of it. They've just been sort of left at the altar waiting for that suitor to show up. And so the suitors will show up when their currency is valued at a high enough valuation that they feel an acquisition could be accretive to their pipeline of projects and their shareholders. And I feel like we are finally getting to that stage where some of the bigger companies' valuations are actually getting up to a point where they're like, okay, let's do some deals.
Well, we'll keep our eyes peeled. I know that some people are still thinking that the projects the majors are going to divest, like Newmont is still going to be divesting some projects, that maybe some of the mid-tiers are waiting for those before they make a move on the juniors. But it's definitely something where we've seen the appreciation in the majors and mid-tiers, not the juniors. But let's dive into the developers in Beaver Creek. I met with a lot of companies, Robert, that had 1 million, 2 million, 3 million, 5 million ounces. And to your point, they were getting valued at a paltry amount, $10, $20, $30 an ounce in the ground. But I was also looking at metals assumptions. So I'd love you to get your thoughts on this. The metals assumption some companies started using was 1,800 and 1,900. And some people thought, well, that's too high. They should be using 1,300 or 1,400. But we're at $2,600 gold. When does the industry raise it to 2,000? Why are we so slow to move it up? If it was a tech company, they'd already be looking at where the prices are. But for some reason in the mining industry, they want to be conservative, but it actually hurts their economic case. So what do you make of developers and the metals assumptions they're using?
Well, I mean, if a company is using 12 or 1,300 an ounce still, then they need to fire their CEO and get a new one in there and redo their presentation, because that's absurd. Gold hasn't been at 1,300 in almost 10 years, right? Or no, sorry, 6 years. But it feels like 10 years. It's been a long time. Even Barrick Gold, is starting to use 1400 now. They're super conservative. They're the most conservative one out there. If they're using 1400, then certainly a junior or a mid-tier could use 15 or 1600. But I'm comfortable with companies using 2000 or even 2100. I think maybe 23 or 2400 is a little aggressive because we haven't been here that long. But certainly 2000 or 2100. I mean, I think that the previous all-time high area is a reasonable level to assume on a conservative basis that could be a relatively low average price for gold for some time to come. And then let investors, use their imaginations. If they want to compute what the ounces in the ground are worth at 2,500 or 2,600, let them do that. And if their opinion is that these prices are here to stay, or maybe gold is going even higher, then they can bet accordingly. But I think using 2,000 an ounce is still pretty fair and frankly pretty reasonable. Yeah.
Well, and let's also talk explorers. With so many companies having been explorers in the past and graduated up to really doing economic studies, they got a resource out, they've already put out a PEA, a PFS, an FS, and they're still sitting there. Do we need 1,000 other companies exploring for gold?
That's a timeless question. I think the answer is we don't. There's too many gold explorers. We could use some consolidation. We could get rid of some of the riffraff for sure. But at the same time, I say that there are some companies out there right now, there's many of them, that have, let's say, $15 to $30 million market caps in Canada, right, on the TSX Venture, that have, legitimate projects, like real exploration projects with drill results, high hit rates, some big intercepts, and they're still at a $20-25 million market cap. For whatever reason, the market either perceives that the scale isn't big enough, they don't like the area of Canada that the project is located in, or for whatever reason, the company has not been able to capture the market's attention and investors' imagination for what's possible. And that, I don't think those companies should close up shop by any stretch, because I think their projects are quite good. But could they consolidate? Yeah, like maybe they could. But then, you have the friction. The management team doesn't want to merge with another management team. The CEO doesn't want to lose his job. Often there's a lot of big egos at play. My project is better than yours, so why should we merge at the same valuation? Blah, blah, blah. So there's a lot of friction. There's a lot of complications, with the idea of doing a consolidation. So that's kind of why you need bigger companies to come in and just say, look, we're going to pay 50% above your 20-day VWAP, and you don't really have a choice. You're going to have to say yes because you don't have a better option, right? So hopefully we start to see some of those deals happen here in the next 6 months. And if we do, I think we'll see some really fantastic gains in the sector.
Well, in Final Jeopardy, I know you're a fan of copper, and copper had a big run in May up to 520. It's pulled back down. Now it's around 420-ish, and so it's lost $1, but it's still presenting some interesting opportunity in the copper juniors. Between the copper juniors or the gold juniors, what would you be more excited about right now? Because gold's ripping, copper isn't, but both sets of juniors present opportunities.
You know what's the best is copper and gold juniors. Like a couple of companies on my panel this weekend at MIF, like Intrepid Metals down in Arizona. They're copper and gold. It's INTR on the TSX Venture. So you get the best of both worlds, And I think, also porphyries in general, you usually get copper and gold. Normally copper dominant, although there's some gold dominant porphyries. Sometimes you get some moly. But I love porphyry systems. I love porphyry explorers. I have a bunch of them in my portfolio. I follow a bunch closely. Yeah, so why not get both copper and gold? But frankly, I think you can have both copper juniors and gold juniors in your portfolio. And in a way, in a weird way, they kind of hedge each other Because if the economy really does worsen a lot, gold is going to go ape shit. Copper might not do well. So your gold juniors should do well. Your copper juniors probably won't do as well. Vice versa, if the economy rebounds and China comes back to life, well, copper could do great. It could be back above $5 a pound in no time, while gold will probably not do as well. So your copper juniors will outperform your gold juniors. So I think in a way, the two kind of hedge each other in a strange way right now. We don't often see it like this, but I think that's the macro backdrop, that we have right now. The more the Fed has to ease, the closer the Fed gets to QE, better gold does. Copper might be a little stagnant just because, the economy is suffering. But if the economy rebounds and housing picks up again, we started to see those home sales, pick up again, copper should do very well.
I think that's a great answer because it's interesting that gold and copper kind of taking different positions across the commodity spectrum, one a monetary metal and one the doctor of the economy. They do hedge each other. And to your point, if you can find companies with both gold and copper internally, they're already internally hedged. So great answers there, Robert, and always great to get you on the show just to see what has your attention in these markets. And if people want to follow along with Robert's work, definitely click on the links below. They take you over to his pages in Twitter /X, also Goldfinger Capital on YouTube and on Substack. And as always, man, looking forward to our next conversation.
Thanks a lot, Shad. Appreciate it.